The EU is a group of nations in Europe that through the late 20th century agreed to fall under one economic banner. The purpose of this consolidation was to eliminate the red tape of international trade between nations who shared close proximity and similar economic interests. Free movement of trade and labor were all things member countries could benefit from, but the regulations and group mentality didn't sit well for all member nations, specifically Britain. It reached a boiling point when Britain proposed a referendum to remove itself from the EU by popular vote. This presentation looks to show and analyze the reasonings for each side's decision, who made up the voting population for both sides, and what the ramifications of the UK decision have on the new British economy. The United Kingdom vote was polarized into two groups of two states, England and Wales voting to leave, and Northern Ireland and Scotland to remain. The margin between yeas and nays for Northern Ireland and Scotland were significant, sharing a strong vote for remaining in the European Union. But the greater population of England and Wales overtook these gains, as these states' majority, although smaller in their margin of victory, supported the return of sovereignty to England's economic status.
The voting results were affected by the economic differences of the regions. Northern Ireland and Scotland are very agriculturally dependent and rely on EU subsidies. Conversely, England and Wales are more commercialized and want less regulations in the marketplace. Age was also very split. About 75% of younger people under the age of 24 voted to remain, while 61% of older voters over the age of 65 voted to leave. This difference is represented in the graph.
Further analysis shows correlations dependent on both the educational and economic standing of the voters. The data shows that the number of voters choosing to remain was inversely proportional to the percentage of residents with formal degrees. This is reinforced by the positive correlation between those with no formal qualifications voting to leave, which points to the economic incentives and demographics of the two groups of states described before. As an example, Northern Ireland and Scotland's agriculture industry is incentivized by subsidies from the European Union. Leaving the EU would put these states' economies in jeopardy as the subsidies ceased. For London and Scotland, industry and business was deemed clogged by regulation, and the economy put in jeopardy by debt-laden EU members like Greece and Italy. But perhaps at the heart of these individuals' decision lay with their income and wealth. The lower someone's income, the more likely they were to vote leave. Those with a greater income deemed the status quo would continue to support their means, and change would only bring about less security in their financials. And they would be right. After the voting had been called, the British pound dropped 20 cents on the dollar, a fall of almost 15%. In the span of nearly 24 hours, Britain's purchasing power took an enormous toll, reaching 30-year lows in the blink of an eye. For the British people, Brexit had come at a significant cost.
A devalued pound has many effects on the macroeconomy. Economic activity decreases overall. The stock market plunged immediately after the vote. The price of imports increases while purchasing power decreases, especially for the wealthy. As prices tend to rise, investing in the UK becomes less attractive. Also, the exchange rate hurts international companies with locations in the UK. At this point in time, only 3 months after the vote, the future of the United Kingdom's economy is still very murky. Many things will take place in the coming months and years to help determine that. These include renegotiated trade deals and immigration policies. Until those happen, consumers and investors will be wary on how to proceed in the post-Brexit world.
This concludes our macroeconomic analysis of the Brexit vote. We hope you enjoyed, and thanks for watching.